It's a nice Saturday morning.
Did you sleep well
Is
yesterday?
I slept like a baby, honestly. Yeah, I've been sleeping really well just because a lot of work to do, so my body tired, my mind tired. How about you? Did you sleep well?
I slept pretty late. I woke up once in a while. Like, I woke up once in a while to check on my trades. But yeah, like it's kind of bad because like you need your sleep, you know.
Yeah.
As a trader, you need your sleep. But in the morning, I just go outside and I chill. Like every morning, around like 6, 7:30, I go outside to just chill in the sun for like an hour or two.
Sun gaze?
Yeah, sun gaze or sunbathe.
Well,
But like
what is that? What's sunbathing?
it's just like good for your body because like it's just
What is
outdoor
it?
nature.
What is it?
Sunbathing.
Yeah.
It's like when you're just outside, just basking in the sun. That's essentially what sunbathing is. You're just taking in sun energy.
Yeah, the sun's energy, right?
Yeah, it's
Yeah,
good
it's
for
really
you.
good. Yeah, the sun gives you nutrients for your bodies that a lot of people don't know, and also gives you energy. People need humans in general just need the sun.
Even plants. Plants
Too,
thrive
yeah.
off the sun as well.
Yeah, a lot of people don't know that though. They just
Yeah.
think like staying inside is good, but like you need sun's energy. Sun's ray gives you like vitamin D
Yeah.
and also help you with like iron creation and calcium.
But
A lot of beneficiaries.
you do it too, right? Sometimes like you
Yeah, I
just
do it. I just go outside and just like chill in the sun for a bit.
because sometimes when I sleep for 5 hours to 6 hours, I could just stay in the sun for like an hour or two, and I could feel like I slept 8 hours. It feels like I just slept 8 hours, so like it feels good.
You feel replenished after, huh?
Yeah.
So let's talk trades now.
All right.
though.
Yeah. Let's talk trade. Yeah.
Let's talk trade.
We went pretty off topic on that, but
Yeah.
it's okay. So how do you minimize risk in the stock market, Mr. Cheese?
How do I Well, the first obvious and clear method of minimizing risk would be to either dollar cost average. Yeah, dollar cost average would be the biggest one. So say you buy it and you buy a stock and you're not really on the downtrend, you don't really buy at the support line. You would dollar cost average, meaning that when it goes down, you could start buying more shares continuously until it reaches the support line. So while it goes down, you can buy like a couple shares here, a couple shares there as it keeps decreasing. And then once it gets to the support line, that's when you should buy a majority of the shares.
So my question to you is, how long do you dollar cost average for your duration?
Well, dollar costing average could take like around 4 months. Basically, like it depends on how long.
To fully dollar cost average your amount.
Fully dollar cost average, I say you stop dollar cost averaging once it gets to once you end the support line. Like you keep dollar cost averaging and entering in until you wait for the support line, and then you buy the majority of your shares right there at the support line.
Okay, wait. So what if it keeps going down and down? What would you do?
If it goes even
it
below,
keeps going down and down. What would you react to that situation?
then I would try to get even more money in there.
Just try to wait for it to come back up, right? Essentially.
No,
You went in.
if it goes down the support line, then I will keep buying until
What if it broke down that support and it just like
and
lower
then
and lower?
skyrockets
Like
down.
what would a trade? How should traders react to that situation?
In that situation, just keep dollar costing average. That's like way discounted price.
Yeah, essentially you can get like half of what you originally paid for like the half amount of money that you have.
Yeah.
Or the amount of money that you have, you get
Yeah.
double your shares if it goes down 50%.
You just keep buying more if it goes down even more.
Because
That's better for
eventually
you.
it's going to reverse up.
Yeah.
Eventually, because like you didn't buy in without doing. You had to buy in with fundamental and technical analysis. So you bought in knowing that this company was like at least a B to A tier quality of
Yeah.
a investment. So
Of stock.
it would eventually have to reverse up. So like like you said, you just keep dollar cost averaging until it eventually comes back up. Like
Yeah.
at least because when you average down, you're gonna get low enough to where you can at least break even when it comes back. At least when it comes back, you can at least break even, or even better when you make more profits. You know what I mean?
Yeah.
But your worst case scenario, you can break even with that trade.
You do even more than break even, because if you're really dollar costing average and it goes below the support line, then you're buying it at such a discounted price that you're gonna make gains, because if you're buying it at like, say it goes way like say it goes like 5% below the support line, right? Then you're getting that 5% plus even more, because it's under the support line. So if you're going 5% under, you're getting that 5% plus, and it's gonna be even more.
If it breaks
If it breaks above too, then you're gonna get even more back. And you're getting like multiple, like it's just gonna multiply at that point. Like you're getting an exponential amount more.
Okay, so do you use stop loss or dollar cost averaging, or a combination of both?
I never use stop loss, just because when I don't go into any pumper dumps. I stopped option trading, and the only thing I'm doing is like holding on to it. Like the least thing I would do, it would be like swing trade. So I don't really need swing trade for that. I just look at it, and like if I think it's a good price, or like say that I see a stock and it's like at a down, like the low point of it, I will see if it's near the support line. If it's near the support line and it's looking like it's gonna break to a bullish trend, then I would buy that and then hold it for like a month or two, and then sell it once it reaches the peak of the bullish.
Okay,
run right
another
there.
question. So if it goes up, let's say it goes up, but you didn't buy a good amount, would you keep buying more if it goes up, or would you just be? It's
No,
okay,
I would
just
yeah,
let it go and just
I would
get
just
the
let that one
profits?
go. I would let that one go and then be happy with the profits. And
You
then
don't buy up, right?
I don't buy up, no. Just because there's a possibility that I'm losing out. Because what if I buy up and it starts going down? Then,
Even
like,
more,
I'm stuck in that
right?
trade.
Yeah, I feel.
Yeah, then I will be stuck in that trade. I don't want to be
Uh-huh.
stuck in the trade. I just want to get the money that I can. If I get profits from it, just leave that trade and then like look for another one to enter.
So how
for
much?
another opportunity.
How much do you enter per trade then? So like for each dollar cost average, like for your first entry, how much would you usually put in? Like 250, or
Yeah.
depending on your capital right now at the
Like
moment.
10, like depending, so it would be like $200 to $300
On the beginning, right?
on the beginning, yeah.
Uh huh. And then you just keep dollar cost averaging
Keep
for how
dollar
long?
cost
For how
average
until?
until I get to the support line, however long that takes. So like I'll wait for it to go near the support line, and if I honestly do,
This is for swing trading. Keep. Is this for investing or long term?
this is for long term. Like this is
Long-term.
this is what you should do for like any type of trading. Just like either swing trade, or like day trading, or long term investing, or long term trading. Wait until it's near the support line or at the support line. Buy the majority of the shares there, and then you can do what you want after.
Okay, so my other question to you is: after the market crashes, how would your ideal portfolio be after the market crashes and it's about to be? What would your ideal portfolio be?
After the market, well, I will look at the great companies that were great already. They're still gonna be great.
Which
It's just
ones
that,
are in your mind?
so like Apple, Tesla, and JP Morgan, Bank of America are all on my mind, and four.
That's four.
That's four. However, if you look at them, Apple, Tesla, Amazon, JP Morgan, Bank of America, those three are very expensive already.
Different
So
sectors.
just
Different sectors.
Different sectors too. Two of them are in the same one, banking, and one of them's a technology one, and then another is a autonomous vehicle, and then another one, what did I say, Amazon, is a online wholesale.
Uh huh.
So those five, I would just go in, because I know they will be at a low point. Like after the crash, they'll be at a discounted price. Actually, I'll enter them during the recession when they're all at a discounted price, and I would just hold on to it, because like during the crash, you're gonna see a boatload of really good, really great stocks at a really discounted price. So that's when you really want to buy at that point, because it's not forever gonna be we're not forever gonna be in a crash. It's only momentarily. So at that point, when it's really discounted, you want to buy as much as you can right there. Like there's no point of holding onto your money during the crash, because it's just inflated money. So there's no real value of it. You might as well have really good stocks of companies that are really good, just so you can have value in the future, because in the future that dollar is still not going to be as worth as much as the stock of that company, that really great company. Because in the future, when the dollar does inflate, which is going to happen, it's going to keep inflating, the company is going to inflate even harder than the dollar does. So then you're going to have more value in that company's stock than you're going to have in that dollar. So you might as well just buy it when it's in the crash, and while you're while it's discounted, then wait until after. So you want to buy it at the most discounted, which is gonna be in the middle and like in the peak of the crash.
Well, I really enjoyed your detailed answer, and it's like you said, it gives people the value when they invest. They have the value of the company. They already have the fundamentals down, because
Yeah.
they're always from their stat sheets that they have been profitable for a long time. So how often do you check up on the stock market, like on a daily basis and on a weekly basis?
Daily,
Like, including Robinhood, or just or not including news, but just Robinhood in general, like to check the price, just to check the price, how many times a day, and then how many times a week?
3 to 5 times a day, and then weekly I say around like 20 times a week.
Also, like just every day, every day of the week, right? You check every day,
Every
even on
day.
the weekends, right? Even on the weekends.
Not really. Okay, unless like I'm looking at a stock,
Researching, right?
That like I'm researching and I can see the potential value of it, then I'll open it up. But like for my portfolio wise, I wouldn't really look at it. I don't really like obsess about it that much. Just cause like mine's long term.
Long term.
And plus, there's one stock that went down even more. So like I'm just playing. At that point, it's just I'm playing the long game, which is AYX. It went down to like 95. So I'm really holding on to it for the long term now. Like long term as in like a year or two for that.
AYX.
Yeah, AYX.
Cloud, is that like clouds? What is that, like cloud system?
Cloud system, technology software, analyzer.
Interesting.
Yeah.
So ever since we made this Discord, what is the one most common mistake you see investors and traders do? Most common mistake.
Most common mistakes that I see a lot of people do, especially on our Discord, and I'm pretty sure this is gonna go out to a lot of amateur and beginning investors, is they get too greedy. They see profits, they get too greedy, they don't put a stop loss, and then they lose out a lot of their money. Or they see FOMO, they feel the FOMO of not being able to put in their money when someone else said that the stock is either going to go up or down. They go FOMO of it, and then they buy in once it reached its peak already. So you're buying at the exhaustion point, and then you're inevitably gonna lose money. I see a lot of people doing that. Don't get greedy. Don't fall for the FOMO. Just always stay calm and reserved, and then think logically, not emotionally. That's what a lot of people see in a lot of people is they get too emotional. They don't think logically, and then they just enter into the market just because they get greedy and too selfish for them. Like they think too much of the gains that they're missing out. However, like there's always gonna be other opportunities for traders and investors to enter in. Just wait for the next one. What about you? What about you though? What do you see? What do you see that a lot of people in our server like messing up on?
So I feel like for our server, it's just earn when they win the profit. Get like at least a daily goal and a weekly goal. Like try to, and then use spreadsheets to track your progress on the trades. Like each month, you should track all your trades and then see your win rate to loss rate and see how you're performing with that strategy. Also, developing your own strategy and doing your own research and due diligence, because like the most common mistake a trader can do is going online and then just looking at someone's analysis and going in without doing their own. Like it's great to read someone's analysis, but make sure you do your own and you enter with your own analysis, because your own strategy, you need to develop your own strategy that you enjoy and most confident with.
Definitely.
So when you enter, you're confident in the trade, and you don't have to worry. Like you're already focused on your trade because you already did the work.
Definitely.
But like it's great to know what other people are looking at, because you could do your own analysis on it. It's totally fine to look at what people are looking at. Just make sure that you do your own due diligence.
That is a good one. I don't see a lot of people on our server doing their own due diligence.
It's as long as they start to work on it, as long as we encourage it as well.
And what you see a lot of people not doing their due diligence is they don't know when to exit out because they don't know the exit points or the target points of when to exit. They just see that it goes up. Some of them make profits, and then they don't exit out because they don't know when to. So they just keep holding on, and then sometimes they lose out on the profit in total, you know. And then sometimes they even go down, like they get decreased, like they lose out on that one.
Oh yeah, that's why I really encourage the stop loss, like you said. Stop loss is very key, because if you use a stop loss, a 2% stop loss or 5% stop loss, if your analysis doesn't go the right way of the market, because the market and your analysis can be different. You can think of one way, but the market does the other. So if it goes the other way, you can reposition. So if you're an option trader, you can reposition to you can follow the market trend as long as it gives confirmation that it isn't going your way with with technical analysis, price action, and also fundamental news that comes out. You can combine those two and figure out which position you want to do after your stop loss has been triggered. Or you can, if it goes down like 20%, you saved yourself from an 18% loss with a 2% stop loss, or 5%, you save 15% from a 5% stop loss.
Yeah.
And you can reposition lower. You can save that money and it's okay you took that loss. And like I said, the best trait to have as a trader is to be okay with losing and understanding that trading is like a train. There's always one coming.
Comes and goes, yeah.
It comes and goes.
Comes
There's
and goes,
always.
yeah.
I remember I was in a couple trades a long time ago where like I just kept holding it, but like it just kept going. So like it told me I was in profits for like 5 times, but then I just kept holding through, and I didn't sell, and then they just ended up going lower.
Down.
But like I could have just sold and just like check out the situation, you know, because if I notice there's something going on, you can just track that really well.
Yeah.
And like I said, just having the best trait is to know that it's okay to be wrong. It's totally fine as long as you have a backup plan, like you said, entries and exit points. When you enter your trade, because I see some people, they enter the trade and then they're just I'm in the trade, and then what if it goes down? You know what I mean? So like, because the market can do anything. The market, we could predict what it's gonna do with analysis, but the market always has its own mind.
Way.
Yeah, a way.
Their own mind and way. No matter how narrow or how precise you think your research is, it won't matter unless because the market moves by itself, like you said, right? So it won't matter how precise your analysis is if the market goes the opposite way of what your analysis says, right?
Exactly.
As long as you're in the green, you're in the green. But if you're in the red, like you're still in the red, you're gonna lose money.
So progressive stop loss, like you said, push the stop loss above your average, so you are in profit when it triggers back down in case of anything that happens, like the major indexes go down, which causes a lot of stocks to go down, or Trump with the Twitter, like he might have said something which scares investors,
or like world news, like the UN coming together and then Trump telling like other countries that they're gonna have like foreign trade wars. Stuff like that can decrease the major indexes.
So
if you saw 2-3 weeks ago when the UN met together and then Trump said that they were going to do trades with the Middle East, they did like foreign trade wars, and then the major index 3 to 2 weeks ago started going down.
Is that when you put the puts, right? Was that when you put the puts?
That's when I put the puts
for SPY, right?
Yeah,
and
that's when I put
like
the puts.
1
Yeah, and then it just went down. I was like, all right.
And up.
Yeah, if you see any world news and it actually means something, then you can predict it to a point.
Because if they're scared,
they're scared.
Taking profits because you don't know what the situation it might be good or might be not. You know
people
what I mean?
People are panicking at that point. Like once people panic, that's a good point to be greedy.
Because the trade war, right?
Yeah, trade wars. When people are really panicking and they don't know what's gonna happen, that's when you want to enter. Or that's when you want to.
Depending on the situation.
Depending on the situation, of course. You want to analyze the situation and go into it, really go into it when it's when you can capitalize on a certain point, like certain situation.
Wow, that was such a great discussion we had right there.
All right, that's it.
That's it.
All right. Tune in for the next podcast. Peace out.